If you run a $2 to $10 million agency and you're scared to raise prices, watch what happened to this $4 million shop when we did it anyway. So I'm gonna walk you through what happened when a $4 million agency raised their prices and what it did to their profit, their close rate, and ultimately what their business is worth. This is a real client. I've changed the names, some of the details, but the numbers are real, and what you're going to see is exactly what a monthly CFO strategy call actually looks like. The process that we run every month with every agency client. So by the end of this, you're gonna see how one constraint identified and solved in the right order moved this agency's enterprise value by millions of dollars. Now let's get into it. So the agency we're looking at today is called Apex. They're a full service digital marketing agency, about 4.1 million in trailing 12-month revenue, a team of about 25 people, roughly 40 active clients, an average retainer of 8,300 a month. Growth has been mostly referral based. Good agency, good reputation, and clients like them. 2 months ago, we identified pricing as the constraint, and the founders started raising prices on new business. Revenue is stable, but they were nervous. And you can see right here, the question on the slide, we raised prices 2 months ago, and I need to know if it's working or if we're just losing deals. And that's what this call is all about. Now let's look at the numbers. So every month we track 10 metrics for every agency client. We call them the core 10: revenue, gross margin, net margin, customer acquisition cost, the lifetime gross profit per client compared to the customer acquisition cost ratio, your churn, and your net monthly recurring revenue movement, labor efficiency, and cash runway. Now that's a lot, and all 10, we normally walk through them on a call, but for this video, I'm gonna show you the top 3 that tell the story for this agency right now. The 3 numbers that matter: gross margin. This is the metric tied to the constraint. It was 50%, now it's 56%. That's a 6-point move in 60 days. The target is 70%, but it's moving in the right direction. Lifetime gross profit per client was 42K. Now the clients signed up at the new pricing are projecting 58K. That's 38% more lifetime gross profit per client. So the new pricing isn't just producing more revenue per client, it's producing fundamentally better client. Close rate was 55% and now it's 43%. And that's the number that keeps the founder up at night. It dropped. So the question is, does it matter? We're gonna answer that with the model. So by about minute 15 of the call, we name the constraint. One sentence, one metric, one target. You can see it right there. Pricing is below the value delivered, compressing gross margins and capping bottom line profit. And I wanna show you the sequence at the bottom of this slide, because this is really what constraint theory looks like in practice for an agency. Pricing unlocks margins. Margins give you cash to invest. Cash funds marketing and hires. Marketing drives growth. Hires reduce key person risk. Each one sets up the next, and you can't skip steps. And that's why pricing is the constraint right now. Not marketing, not hiring, not sales systems, because without the margins, there's no budget for any of that. So this is the part of the call that usually changes how the founder thinks about their business, because up until now, we've been looking at percentages. Now we're gonna see what those percentages mean in actual dollars, and the model depends on the constraint. If it's cash flow, I'm running a 13-week forecast. If it's capacity, I'm modeling the P&L at different headcount levels. If it's cost control, we're pulling up the budget versus actual. But for this agency, the constraint is pricing, so the model is simple. Same 4 million in revenue, same 1.5 million in overhead, only pricing changes. On the left is before, 50% gross margin, 2 million in gross profit, after overhead, 500K net. On the right, after 70% gross margin, 2.8 million in gross profit, same overhead, but 1.3 million net. And that bottom line, that's $800,000 more per year. No new clients, no new hires, just pricing. Every dollar of price increase on the same delivery cost drops straight to the bottom line, and that's why pricing is the highest leverage thing an agency can do. But the founder's question was, what about close rates? So I modeled that too, and you can see the 3 columns here: before, after, and at the floor. So before was a 55% close rate, $8,300 average, about $22,825 a month in gross profit from new business. After, 43% close rate, $10,500 average, fewer clients, but $25,284 a month in gross profit. More profit dollars from fewer clients. And even at the 40% floor, still $26,460, still ahead. So when the founder asked, am I just losing deals? The answer was yes, your close rate dropped, but you're making more money because of it. And that's what this model does. It eases your anxiety around decision making because the math is clear. Once the client could see the dollar impact and we get to the decision, I always lay out real options. So here you can see there's 3 cards. Gradual, just reprice the small clients, 20K a month upside. Systematic, tier the full book, reprice over 90 days, 25 to 35K a month in extra gross profit. And then aggressive, across the board next month, maximum speed but real churn risk. The founder chose B, systematic, and the line at the bottom is the most important thing on this slide. We are not adding headcount for at least 90 days. Choosing means not choosing, and naming what you're not doing keeps everyone honest. We build a month 1, month 2, month 3 map, and every bullet attacks the same constraint. You can see the 3 headers at the top. Month 1 done, month 2 current, month 3 next. Then 3 actions, and every one has an owner, a deadline, and a metric, and a current and target number and dollar estimate. Action 1, tier the clients, build the rate packages, done in 2 weeks. Action 2, top 10 legacy clients, repricing conversations done by end of month, legacy gross margin from 48% to 58%, estimated 15 to 20K per month more in profit. Action 3, rate adjustment letters for everyone else, 10 to 15K more per month, total estimated impact 25,000 to 35,000 more per month. That's 300,000 to 420,000 a year from one constraint. And the commitment section at the bottom, the founder said 8 out of 10. I asked what would make it a 10. He said, if I knew what to say in the conversations. So we booked a 30-minute role play prep session, and now he's at a 10. After the call, I sent a 3-bullet summary email the same day. The constraint, the plan, the actions. It takes 5 minutes, and that's what the client refers back to every week. So here's the part that most agencies never see, because most agencies are focused on the P&L and what I did to make this month. But the real question is, what is this business worth? And pricing doesn't just change profit, it changes what the business is worth, because it changes EBITDA. And EBITDA is what drives the multiple. And the multiple is what drives enterprise value. So look at this table. On the left today, on the right 12 to 18 months from now if we execute the plan. Revenue goes from 4.1 to 4.5 million, modest growth. We're not trying to double the business. We're fixing the economics. Gross margin goes from 50% to 65, 70%. And EBITDA, this is the line that matters. It goes from 500K to 1.1, 1.3 million. And that's a big deal, because once you cross 1 million in EBITDA, the base multiple changes. Below 1 million, you're looking at roughly 3x. Above 1 million, it's 4 to 5x. So it's not just the EBITDA that doubles, the multiple goes up at the same time. Key person risk, still high today, but the margin improvements fund the management hires that start reducing it. Data risk moves from partial to dashboards in a monthly cadence, which is literally what this CFO call is. And the bottom line, enterprise value goes from roughly 1.5 million today to potentially 4.5, 6.5 million in 12 to 18 months. That's not from doubling revenue. That's from fixing pricing, which fixes margins, which crosses the EBITDA threshold, which changes the multiple. And then you start reducing risk, which pushes the multiple even higher. Look at the sequence at the bottom. Pricing improves margins. Higher margins gets you cash to invest in marketing, hires, and growth. New leadership hires reduce risk, and that's ultimately what gets you a higher multiple. Each one sets up the next, and that's constraint theory in practice. So that's what a monthly CFO strategy call looks like. Not a P&L line-by-line review, not a tax update. It's one constraint, the math on fixing it, and what it's worth. Not just to this year's profit, but the business as a whole. Concrete decisions with dollar tags and a plan that actually tells you what to do, who's doing it, and by when. So if you're running a $2 to $10 million agency and you've never had a call like this, we do a free agency profit benchmark and valuation workshop. That's where we diagnose your constraint and show you the math on what fixing it is actually worth. There's a link below to apply. If this was useful, subscribe. More of these coming. Real numbers, real agencies, real constraints. Thanks for watching.